Are you curious about interest rates and how they work? Interest rates are a key factor in the economy and can have a significant impact on individuals and businesses. In this video, we will explore what interest rates are, how they work, and the factors that influence them. We will also look at how they affect our daily lives and how to best manage them. Interest rates work by balancing the supply and demand for funds in the economy. When there is more demand for funds than there is supply, interest rates tend to rise. And when there is more supply than demand, interest rates tend to fall. Interest rates are usually set by central banks or other monetary authorities, which adjust them in response to changes in economic conditions. For example, if an economy is experiencing high inflation, a central bank may raise interest rates to reduce spending and slow down the economy. Alternatively, if an economy is in a recession, a central bank may lower interest rates to encourage borrowing and spending, which can help to stimulate economic growth. When individuals or businesses borrow money, they typically pay an interest rate that reflects the risk involved in lending to them. Borrowers with good credit ratings and a history of paying back loans on time are generally offered lower interest rates than those with poor credit ratings or a history of defaulting on loans. This is because lenders see them as less risky and are willing to charge them lower interest rates to compete for their business. Interest rates are a critical part of the economy because they influence the cost and availability of credit, which can have a significant impact on the spending and investment decisions of individuals and businesses. Here are a few key reasons why interest rates are important. They affect borrowing costs. Interest rates can significantly affect the cost of borrowing for both individuals and businesses. When interest rates are high, borrowing becomes more expensive, which can discourage borrowing and reduce overall spending. Conversely, when interest rates are low, borrowing becomes more affordable, which can encourage borrowing and stimulate economic activity. They influence investment decisions. Interest rates can also influence investment decisions, as higher interest rates can make it more expensive for businesses to finance investments and expansions. Similarly, higher interest rates can make certain investments less attractive for individuals, as the returns on those investments may not be able to keep pace with the cost of borrowing. They impact inflation. Interest rates can have a significant impact on inflation, which is the rate at which prices are increasing in the economy. High interest rates can help to slow down inflation by reducing spending and slowing economic growth, while low interest rates can encourage spending and contribute to inflation. They affect exchange rates. Interest rates can also impact exchange rates, which are the values of one currency relative to another. Higher interest rates can make a currency more attractive to foreign investors, as they can earn higher returns on their investments. This increased demand for the currency can cause its value to rise relative to other currencies. Given these factors, central banks and other monetary authorities closely monitor interest rates and adjust them as necessary to maintain stable economic conditions. There are several factors that can influence interest rates, including inflation. Inflation is a measure of how much prices are increasing in the economy. When inflation is high, interest rates tend to be high as well, as lenders demand a higher rate of return to account for the eroding value of their money over time. Central bank policy. Central banks are responsible for setting short-term interest rates, and they often adjust these rates in response to economic conditions. If the central bank wants to stimulate economic growth, it may lower interest rates to encourage borrowing and spending. Conversely, if it wants to slow down an overheating economy or combat inflation, it may raise interest rates to reduce spending and borrowing. Economic growth. Interest rates are often tied to economic growth, as a strong economy can drive up demand for credit and borrowing. If the economy is growing rapidly, interest rates may be higher to keep inflation in check and prevent an overheating economy. Government borrowing. Governments also borrow money, and the amount they borrow can influence interest rates. When the government borrows more money, it can increase demand for credit, which can push interest rates higher. Supply and demand for credit. Interest rates are ultimately driven by supply and demand for credit. If there is a lot of money available to lend and not enough borrowers, interest rates may be lower. Conversely, if there are more borrowers than available funds, interest rates may be higher. Credit risk. The riskiness of the borrower can also influence interest rates. Borrowers with a high credit rating and a history of paying back loans on time are typically viewed as less risky and may be able to secure lower interest rates. Conversely, borrowers with poor credit may need to pay higher interest rates to compensate for the increased risk of default. These are just a few of the many factors that can influence interest rates. Understanding the complex interplay between these factors is critical to predicting future interest rate movements and making informed financial decisions. Interest rates can have a significant impact on our daily lives, affecting the cost of borrowing, the returns on our investments, and the rate of inflation. By staying informed about economic conditions, seeking professional guidance, and managing debt and savings effectively, we can help to minimize the impact of interest rate fluctuations and achieve our long-term financial goals. Interest rates may seem complex, but with a little knowledge and discipline, we can all manage them effectively. Thanks for watching.